Alex. So Alex is the Division Director in Macquarie Fund's Fixed Income and Currency team. He's the Senior Investment Specialist and heads up the Fixed Income Product Management team. And prior to joining Macquarie, he was a Product Manager at the Australian Securities Exchange. Alex holds a Master's in Industrial and Mechanical Engineering from the Institut Catholique d'Arts Cemetiers in France, and an MBA from the Australian Graduate School of Management. And now Alex tells me he has to head off a little bit before drinks, because he does work for Macquarie, so I think we've got a couple more hours of work to do back in the office. But, so please ask lots of questions as we go through. He's happy to take questions as he goes through it, or at the end of his presentation. So thank you, Alex.
Thank you very much. Thank you. So, as you will hear from my accent, my background is French. And in France, we love to debate, to be interrupted. So, any questions, please do so. I don't mind being interrupted, so that's fine. I'll probably ask you questions as well. So, what we'll do more so is, rather than talking about the fund that we manage for you, is more about the economic environment. So, what's happening. And what's happening in this environment is actually fascinating. It's very different from environments we went through in the past. And we'll go through that. So, no. If you can read here, but that's basically the environment that we're in. And the most important is this one here. Massive central bank intervention. Central banks play a role that we've never seen before. Right? And a role that has a very, very big impact. And we'll talk about this. We'll talk about what central banks are currently doing in this environment. But basically, the reason why central banks are here is to make things better, right? To create growth. But we don't really see growth, right? Which is strange because, again, massive central bank intervention. However, what we see, we still have too much debt. And remember, the reason for the crisis in 2007 was leverage, was debt. Well, the level of debt now is actually higher than what it was in 2007. Right? And finally, when it comes to, I'm not sure you can read here, when it comes to investing, we're actually seeing a shift from a very strong focus on capital growth to income. So, a very large shift to income investing. So we'll go through these themes, and again, please, did I do that? Or did you? Okay, great, that works. So, central banks. What are central banks doing, or what were they doing initially, traditionally? Well, central banks, what they do is actually to manage interest rates, right? So if the economy is doing very, very well, they increase interest rates, and if the economy is not doing well, they do increase interest rates to increase activities and productivity and production. But now, recently, what we've seen is, following the crisis, that's not enough. They've done other things. They decided to print money, right? So, but before we talk about money printing, and let's go back to the traditional monetary policy. All the big central banks in the world now, Bank of England, the Fed in the US, European Central Bank, all have the interest rates at zero, or around zero. So my question to you is, when is the last time we saw all these central banks having a 0% interest rate monetary policy? Who said that? Yes. Well, that was quick. Never. Right? So that shows that the problem is acute. There's some issues. So that's not enough. So they decide to print money. Right? So here, that's a bit complex, but basically what do? The central banks, well, they buy the bonds from financial institutions, from banks, and they provide the money to the banks. Right? And what's the idea behind that? Is, well, for the banks to create loan, for people to borrow, and to stimulate the economy. Right? So now, how much money have they printed? Let's look at this. 2008. That year, in orange, is all the big central banks together combined. And in blue here, that's the US. Right? That is thousands of billions, which equates to trillions. Right? All these central banks together have printed around 10 trillion in the last 6 years. 10 trillion. That is a lot of money. Right? The US, 4 trillion. And what is very interesting here is, look, that's last year, 2013. I mean, how acute was the problem last year? It was not great, it wasn't bad, right? I mean, it was not a situation where the financial market would collapse. They still printed 1 trillion. 1 trillion. And I don't know if you remember, do you know long-term capital management? Long-term capital management was a hedge fund that collapsed in 1998, right? And when that hedge fund collapsed, that hedge fund had a lot of leverage trades, right? And the collapse of that hedge fund threatened at the time financial markets. And financial markets were about to collapse. So the Fed in the US had to intervene, right, to save that hedge fund, LTCM, long-term capital management. And what happened is the Reserve, the Fed, the New York Fed, called all the big banks in the office. It was 10 p.m. or 8 p.m. saying, look, we have to bail out that hedge fund. You've got to put money on the table. So they agreed on a package to basically save financial markets. 1998, how much do you think was the size of the package to save financial markets? 1998, it was 20 years ago, let's say, or 15 years ago. What was the package at the time that saved financial markets? 100 million? Billion? 100 billion? 3.1 billion. 3.1 billion in 98 was enough to save financial markets. We're talking here, printing 10 trillion. So guess what we're saying here? There's a lot of things happening here. We're going to territories we've never been before. So things that we think about when that happens, like, well, what are the exit strategies? Right? We are in uncharted territories. Do we really know how to exit this environment? Maybe, but maybe not. Right? What are the consequences? What are the unintended consequences? So we think about these things. We have to think about these things. Right? But what I want to show is like, that's unusual, and we got used to it. We got used to the unusual. So, as I said before, the idea is printing money. They give the money to the banks, and now the banks lend, so the money goes into the economy, in the real economy, right? And we start now spending, and industries, companies invest. This is not happening. So why do you think it's not happening? Because the money is in the banks. Why isn't the money flowing to the real economy? Sorry? Yes, exactly right. So the first one, lack of confidence. And second, people don't want to borrow. Companies don't want to invest. So you can lower interest rates at as low as you can, I mean zero, if companies and individuals prefer to repair their balance sheet, they're not going to borrow. And that's what we call a balance sheet recession. Right? They don't borrow. So the money basically stayed within the banks.
Is that because capital?
Well, that's because the confidence is the big thing. There's no confidence. They don't know what the future will be. And they want to repair their balance sheet. They want to reduce the debt rather than just increasing, taking on more debt. Right? And usually 4% is seen, especially in the US. Maybe I don't hear that actually, right? Can you hear me? Okay, quite good.
Maybe it's just for the...
Okay, yeah, sure. Yeah. So 4% is the print that is seen as the normal GDP growth. And why is that? It's because historically it has been the case. So the last 40 years, GDP trend has been 4%, right? So the idea is like, okay, if it's been the trend in the past, it should be the trend going forward. Right? So basically, since the US started to print money, around here, 2008, we've never seen any print of GDP above 4%. And we've only seen a few above 3%. Economic growth is coming down. And why is that? It's because we don't see consumers consuming the way they were doing, and we don't see corporates investing the way they were doing. And you're right, confidence is one reason. Companies don't invest. They hoard the cash. But we don't see strong GDP prints here. And look at the forecast. In the future for GDP growth, it's come down. So economic growth is to come down.
Even after the G20 meeting?
Yeah, probably a bit more. That was the question? Yes?
So, a company's able to go outside of that market. So they've got a measure of how much they sell more more shares on the market so that it avoids going to the market?
Well, what they're doing, they actually, what they're doing now, because they've got too much money, they're actually rewarding equity holders. So they do share buybacks, they increase dividend. But when it comes to leveraging or access to capital, apart from banks, which by the regulator are asked to actually issue more equities, we don't see much appetite for debt or for capital from companies at this stage. Or less than you would expect in this environment. We always talk about, that's all right, the recovery is about to pick up, the recovery is about to pick up. We've been in a recovery for 5 years now, almost 6 years. Right? The average size of a recovery is 5 years. We almost should be in a recession now. But we don't see this pick up, this economic pick up in growth. Now debt. As I said, the reason for the crisis in 2007 was too much leverage, too much debt. Well, the leverage, the global leverage, the total leverage is actually increased. But what we've seen is more public debt and a little bit less corporate debt. Not so much, but a little bit less corporate debt, but much more public debt. So basically, in 2007 and 8, what happened is the public sector bailed out the private sector. You can see here, look at the debt of Japan, 200% of GDP. Japan. If Japan were to pay the debt, so a country, how does a country make money? What's the income of a country? Taxes. Direct taxes. We all know that very well, taxes. Even increased to 49%. Well, for the highest bracket. Taxes. If Japan were to pay its debt, 220% of GDP, it would need 27 years of its tax receipt. 27 years of its tax receipt to pay its debt. But the other countries also, the debts are increasing. So the questions also we ask ourselves is, on the long run, can these countries actually pay back the debt? However, when we think about interest rates being very, very low, as they are now, and we talked about monetary policy being at 0%. When you see this here, can the world afford high interest rates? Can you put on more pressure on these countries when they've got to pay back so much debt and increase interest rates? Probably not. So we believe we're likely in an environment of low interest rates for a long time, and low growth for a long time, because there's so much debt. You have to repay the debt or you default, because something has to happen.
China is at the end of China. So what's the percentage?
Yeah, it's very hard to know. It's very hard to. Yeah, there's a very strong shadow banking system, which is off balance sheet. What we know about China is it's slowing down. To what level we don't really know in terms of economic activity. But surely China is slowing down. In terms of debt, to have the right data is very, very difficult. But there's a massive issue from what's called the off-balance sheet sector, the shadow banking system, which is the debt that is outside of the bank's balance sheet. Very big problem. Very, very big problem.
So what is the percentage of GDP paid for what officially?
In China, I'm not sure about the data. But certainly the government is trying to reduce this off-balance sheet type of debt activity and taking some measures to do that. But now they know that if they do that, that has an impact also on the economy. So it's a fine balance, but they're trying to address that.
Just to put it into context, where does Australia sit?
Yeah, Australia's not too bad. I think Australia is around 40 or 50%. I think it's around 40% of GDP.
The countries that have zero interest rates, I imagine that's lending. If you want to borrow money, what's the borrowing rate?
If you want to borrow in these countries, as an individual?
No, as a company.
As a company?
Or an individual.
So what happens is, so let's say 0% is almost what's called the risk-free rate, or a little bit more than that. Then based on your credit quality, basically you apply a premium to that. So on average, the average company is probably a premium of 1.5 to 2% above that. So let's say this company's borrow at 2.5, 3%. But also, that's going to hurt the savers, the people who want to save money. I mean, the first time I had some money in France and I asked the bank, so I want to put this in term deposits, and they said, well, do you want 0.25 or 0.4%? I was, sorry. But that's the rates they were providing. So in a way, even though it's low here, we're pretty lucky. So now, I mean, in terms of the recovery, there is one country that is doing quite well, is the US. There's no doubt that the US is doing better, right? It is doing better. But now I show you here, that's a few, all the crises in the US since World War II, based on unemployment and employment. Here, and each crisis is in color. So in blue you've got 1948, in green 1953, and 2007 it's in black. Basically here it's the peak employment, then the recession, you lose job, and then you create job. The first thing you note is the crisis that lost the most job is 2007. Right? But look at the recovery. By far it took the longest. It's incredible. Right? Now we did recoup the number of jobs that were lost to the crisis. But nevertheless, it took, what, 6 years? Almost 7 years. Well, a bit less actually, because it started. And now, when you drill down, when you analyze those jobs, what is very interesting is the average salary of these jobs here that were created are 25% lower than the salaries of the jobs that were lost.
Because of the loss of manufacturing.
That's right, part-timers and things like this. So, yeah, it's, from a cyclical perspective, it's better, but from a structural perspective, it's not great. Nevertheless, the US is doing good, and the US is the engine when it comes to take GDP growth, world GDP growth forward, with China, of course. Now, a byproduct of this central bank activity with this strong injection of liquidity in the economies is we've seen a pickup in asset prices. Right? Asset prices have increased, there's no doubt, and especially equities, properties. And look at equities here since 2009, right? In blue, that's the S&P 500 in the US, and in orange here is the increase in the balance sheet of the Fed. Right? It's very well correlated. So when it comes to asset prices, and when it comes to managing, for example, the fund that Anthony talked about, we're very mindful of that. We know that that can correct itself very quickly. So we're very mindful of when it comes to investing in risky assets, just because we think it's a little bit artificial. Right? Whereas really fueled asset prices here, we believe it's central bank activity, because there's no growth, there's no economic activity. Right? And now, when I talk about growth, I mean, one way you can define growth or acknowledge there is growth is through inflation. Right? We don't see inflationary pressure. The only places there's a little bit of inflation is actually the US and Japan. In Japan, it's the wrong inflation. And one way you can actually see if there's inflation or not is through commodity prices. Look at commodity prices here, coming down. So we talk about China. That's also a sign of lower activity in China. So lower commodity prices. And finally, the last thing I want to touch on is, which is I think quite interesting, is remember I talked about 4% GDP growth being the norm. You know, economists, investors will think 4% GDP growth is the norm. What you can see here, GDP growth peaked around, let's say, the 1960s, and then came down. What do you think is the biggest driver of GDP growth? It's a hard one. Oh, Jimmy, you would know that. Oh, nice one. Population growth. Right? Population growth. Let's look at this. Population growth in orange. Right? The trend is the same. Up, down. Which makes sense, right? The more things, I mean, the more people you have, the more widget you've got to manufacture, the more stuff you need. So it does make sense. But populations are aging. In all the countries, the only place in the world where population is not aging is Africa. Even in emerging market countries in Asia, in emerging market countries in Latin America, population growth is coming down. Population are aging. So when you see this trend in orange coming down, in our mind, that means the trend of GDP growth will also come down. So when we talk about this 4% being this normal rate, will that be the case going forward? Probably not. We believe that we are in an environment of lower growth, and that's one big reason, because population growth is coming down. Right? I mean, that has also a lot of impact, other impacts on pensions, on healthcare costs, things like this. But just from the point of view of GDP growth, unlikely that we see the same prints going forward than we used to in the past. All right? Any question on the economic environment that I just described? No? All right. So I'll briefly touch on the fund that we manage for you. And basically, the way we manage assets is as Anthony was mentioning, we are a conservative manager. Right? What we look at, or what were the big bias for us, is capital preservation. It's preserving capital. It's not chasing yield. It's not trying to have the best return at all time. We want to make sure that we don't create drawdowns or losses for your capital. So the big part of the portfolio, the core of the portfolio, is what we call high quality corporate bonds. When you read investment grade here, investment grade means high quality bonds, high quality, AAA, AA.
How are they judged?
Sorry?
Asking how are they judged in the past.
Well, yeah, so you have to do your analysis, right? That's right. But here you have some like ANZ, CBA, Westfield, strong names. And then when we think it's right, we complement with riskier investments. What's called high yield here. High yield is almost like it's called junk bonds, right? But a company like Ford used to be junk bond, so you potentially can invest in Ford through high yield. Emerging markets, higher risk, and hybrids here, hybrid securities. As you can see here, we don't have investments here. And why is that? Is because I talked about the reason why you see asset prices going up. It's not because fundamentally they're good, it's just because central bank activity. So in that case, we prefer to be out. We think they're too expensive, and we think they're inflated for the wrong reasons. And hybrids, the reason why we're not in hybrids is because in this environment that's highly regulated, and hybrids are usually issued by banks, the regulator is asking the banks to issue equity-like capital. And more the hybrids have equity-like features. Right? So the hybrids could be a good investment, but we believe that it should be done by your equity portfolio, not by your fixed income portfolio. Right? So that's why in this environment, we're not in hybrids. So it's mostly high-quality corporate bonds, and that's what we invest into. And I think that's, I just showed probably this one here, regional breakdown. It's mostly Australia. We like Australian assets. Australia's still doing well. The cash rate is higher than any other country. And so strong names, high quality names in Australia. Some of the names we invest into: ANZ Bank, Port of Brisbane, Stockland. So strong balance sheets. And I think that's probably the last slide I want to touch on, which is, I talked about capital preservation. So that fund has been around for more than 10 years now, 11 years. And here you have the negative returns, negative month, sorry. Right? And here the positive month. Right? So you can see it's very much skewed towards the positive months. Right? But small returns, we're not trying to have fantastic monthly returns. Just month in, month out, nice returns. So the fund has been around for 133 months, and we had 123 months of positive returns, only 10 months of negative returns, going through the crisis, right? The biggest credit crisis ever. So Jimmy here is a very big cricket player, famous cricket player, and because I'm not from a cricket country, but as you would say in cricket, it's about hitting singles, but not sixes. That's what we're doing here, singles. Very conservative. And that's the you've got the returns here of the fund. 6 months, 1 year, 3 year, 5 years, compared to the index here. So nice, steady returns. Do you have any question?
What's the minimum amount?
Sorry?
What's the minimum amount?
20,000. Sorry. Yes.
So has he had a negative month? The actual total value goes down?
So what happened, I talked to, when you asked the questions like, at what rate company borrow? And they borrow, you've got a premium above, let's say, the risk-free rate. When the premium increases, you incur a loss, a capital loss in the strategy. So when there is a view that the credit, that the corporate bonds you invest into, the value of that credit is going down, the premium increases, and then there is some depreciation in the strategy. So it's based on credit risk. Basically, the credit quality, you think it's coming down, it's becoming more negative, then you have a depreciation. But there is no link to interest rates. You may know that bonds, the price come down when interest rate go up, or the price go up when interest rate come down. Here we don't have that impact here because it's a bit technical here, but we have what's called floating rate notes, which are not impacted by interest rate movements. It's only credit risk. So that's how you can control loss. So through the crisis, loss of confidence in credit, so the premium increased, and that means there is a bit of loss. There is a bit of loss in the strategy, but very minimal.
Does that say if you put $20,000 in for 6 months, you only get 1.65%?
The last 6 months, yes. Yeah. So what happened is yes, right. And also the last 2 or 3 months have been difficult in markets.
Monty, most of your products not available to retail. Most of the things you're investing in, a retail investor can't invest in.
Yeah, for sure. Yeah. That's actually it's a good question. Actually, that product was designed for retail investors. So it's in a vehicle that is for retail investors. Yeah.
What's the management fee?
49 basis points. So there is a perception that Macquarie is all about high fees, right? This product is probably the lowest fee product in its peer category. 49 basis points, which is 0.5%.
How does your fund compare with a managed fund such as Platinum or Magellan?
So these are more equities funds. So that's fixed. So we invest in corporate bonds. So whereas the Magellan and Platinum, we invest in equities. So they probably be riskier, but when the markets are good, they will provide higher returns. But they're more volatile. So when markets are bad, you'll have a very strong correction, and then you'll have probably negative returns. Whereas here, it's more about keeping the coupon, getting the interest rates every month, as opposed to having a volatile solution. So it's more the defensive part of your portfolio. So yeah, companies, these two funds, they work together.
Back to your very early slide where you showed the printing of money
Yeah.
dropping off in space,
Yeah.
productivity dropping. At a point in time, surely that productivity must need to change direction. Yeah. What's the prediction for inflation when those two curves start coming together?
We actually we're about to launch a research paper on inflation, and it's actually very interesting because from a cyclical perspective, there could be a little bit of an uptick in inflation. Not in every country, but in some countries like the US. But from a structural perspective, we don't see any inflation coming through. And that's because too much debt. That's because employment is still very high. So structurally, we see an environment of low growth for a very long time. So we think the environment has changed structurally.
So Dick Smith's head in his wish.
I don't know, what was his wish?
No, great.
Yes, he is. He is, for sure.
We shouldn't be addicted to that.
Yeah. We were an unusual generation whereby we had for the first time access to debt, which were also the baby boomers, the largest generation. So access to debt for the first time. You also had financial innovation, which provided more debt. And we saw that in the US with this also called the shadow banking system. So you almost had a perfect storm for debt, for access to debt, for leverage. And that's why we saw these big prints of GDP. But I think that's the abnormal. The abnormal is what we went through. The normal is probably what we're going to see going forward and what happened before the 60s. It's an environment of lower debt, less debt usage. So lower lifestyle, different lifestyle.
we might wind it up just in the interest of time, but it's been done. So, please, Alex.
Thank you.